Hey everyone, and welcome back to another video for today. So we are at the end of 2025, last month of the year. It's been quite a good year, let's be honest. Yes, it's true that over the past couple of weeks, things might not have looked as good as expected. But then again, if you look at year to date here across the board, the performance of a lot of the stocks that we talk about, that we own, that we cover, they've been very, very good. So yes, over the past couple of weeks, maybe last month or so, things haven't looked great, right? If we look at the last month's performance, we've seen a lot of red. But then again, if we zoom out and we look at what has happened this year since the start of the year, I don't think we can complain. And so, in today's video for the last month of this year, I do want to touch on, well, 4 companies. Some of them I own, some of them I do not. But I'll also talk about what I'm thinking of doing as we prepare ourselves for 2026. Now, hopefully you're still watching this on a Monday because there still is that promo going on for Fiscal.ai, 30% off that runs through 11:59 p.m. Eastern Monday. So if you're watching this on Tuesday, fortunately, it's only going to be 15% off. Really appreciate everyone that has been using my link, and hopefully you do become a better investor thanks to it. And so in today's video, these are the companies we are going to cover. Yes, some familiar names here, of course. Hopefully you do keep watching, and if not, at least leave me a like and a comment. Now, what will I be buying? Well, it really depends on what the market is going to give us over the next couple of weeks. There are some names, as you know, right? The names where my allocation is still not as big as what I want. The Oscars, Shift4, Rubrik, things like that. I'll continue to accumulate more shares. But the same can be said for bigger positions. Even if SoFi drops more or if Nebius keeps dropping, although we've seen a slight recovery today, I'll accumulate more shares accordingly. And of course, if I didn't have my PayPal options, I would definitely be buying quite a lot of PayPal right now. You might agree, you might disagree, that's fine. And some might say, oh, but you're always talking about the same companies. Well, let's be honest, I think I've covered around 100 companies this year, so I don't think I'm talking about the same companies every single time. But if the company does not become worse and the stock becomes cheaper, then yes, I will talk about it yet again. And so first up, let's talk about Sea Limited. Year to date, stock has been performing quite well. It's up 31.4%, but it has been experiencing a small drawdown. It's currently experiencing an around 30% drawdown from its peak this year. It's a company worth $82.3 billion. Yes, if you purely look at PE, trading PE 60, 401, 32.2 times, it might seem extremely expensive and that's why the stock is down. Well, just have to look at the growth rates. This is still a company that is growing top and bottom lines, especially bottom line, quite quickly. And if we look at the margins of the company, they've been improving. So now 8.2% operating margin over the past 12 months, free cash flow margin 18.5%, gross profit margin closer to 45%, and net profit margin here 6.7%. Looking at return on invested capital, we're sitting now at 8.3% over the past 12 months, and that has been improving. Of course, all of that data is available to you on Fiscal.ai. Link is down in the description and in the pinned comment. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, as you can see, yes, pun intended, I know, I am so funny, I need my own Netflix special. But anyways, growth rates for this company, of course, they have been coming down. You cannot continue to grow 120% or so year over year, but it's still expected to grow revenue quite rapidly over the next coming fiscal years. Free cash flow is also growing nicely. This fiscal year, it dips 11.5% growth, that's it. But then that's expected to reaccelerate and grow 27.19% in fiscal 26, and then 16.5% in fiscal 27. Now, there are some specific metrics that we can track for this company, especially when you're looking at digital entertainment, Garena, for example. We see their quarterly active user counts. Over the last couple of quarters, we've seen it stabilize, although still growing, but quarterly paying user ratio has gone up. Last quarter, that was 9.8%. Then looking at GMV, more specifically for Shopee, yes, Sea Limited is the company that owns Shopee. This one is also still growing rapidly. This quarter, growth of around 28% year over year. There are three business segments here: e-commerce, which is basically Shopee; digital finance services, which was previously C-Money, which is now something else; and digital entertainment, which is Garena Free Fire, for example. And you can see that over the past 5 years, e-commerce has grown at 47.3% compounded, digital financial services 132%, of course, very, very small base, and then digital entertainment only grew 2.8%, was much bigger, of course, during the pandemic. Then they had this whole India issue, and now, well, it doesn't grow that fast, but at least it's growing. And so as you can see, it's experiencing a drawdown of around 31% from its peak. It's not oversold anymore. We are definitely under the moving averages, the 200, the 100, and the 50-day one. It seems like 155 is really a point where the stock needs to go and needs to go above it in order to, well, continue the uptrend. The 200-day moving average does sit around $150. Moving on to company number 2, and that's Toast, ticker symbol TOST. This is a company worth around $20.1 billion. Year to date, it's down 4.2%, and it is currently experiencing a drawdown of around 29.3%. Here as well, if we're purely looking at some pricing metrics, so trailing PE 80.2 times, but forward one basically 30 times. Why is that? Well, you can clearly see EPS is expected to grow quite quickly over the next 2 years, and even revenue still expected to grow 21.9% compounded over the next 2 years. Looking at margins for the business, you can clearly see that operating margin has been improving each and every year, now at 4.1%. Free cash flow margin at 9.6%, also improving nicely. Gross profit margin 25.7%, and net profit margin at 4.7% right now. All of those, of course, last 12 months. Then if we look at the return on invested capital for Toast, that sits at 45.7%, which is extremely good. Now, last quarter, they did tell us the following thing. They have, of course, had a strategic partnership with Uber, so they expanded their partnership with Uber that will facilitate demand generation and joint go-to-market efforts. Marquee customer wins like Nordstrom, nearly 200 dining locations, TGI Fridays for US footprint, and Everbowl over 100 units, demonstrating platform versatility across various restaurant types and size, right? We talked about Shift4 quite a lot, and Shift4, when you look at hospitality, stadium, sports, and all of that, you look at restaurants, for Shift4, they're number 2. So you're asking yourself, who's number 1? Well, Toast. Toast is basically number 1 in the United States. For the fourth quarter, Toast anticipates total fintech and subscription gross profit to grow in the range of 22 to 25% year over year, with adjusted EBITDA projected to be between $140 and $150 million. Building on strong year-to-date results, the full year 2025 outlook has been raised, with expected total fintech and subscription gross profit growth at 32% at the midpoint, and adjusted EBITDA at $615 million. Now, looking ahead to 2026, the company does aim to sustain growth over 20% at its multi-billion-dollar scale, with margins expected to be flat to slightly up year over year, underpinned by the core business 40% EBITDA margin and continued strategic investments in new market segments. And so this is basically what we get for Toast: 22.2% currently the analyst expectations for revenue growth in 2025, close to 20% in 26, and then 16.5% in fiscal 27. As for free cash flow, that's expected to grow faster than revenue to reach $885.5 million in fiscal 27 and still be growing 21.7%. The company generates revenue through 2 business segments: subscription services, which is the small part, and then the big part here is financial technology solutions. Over the past 4 years or so, the small part has grown faster, 51.7% compounded, and the other one at 35.1%. Looking at ARR, last quarter was the first quarter where ARR was above $2 billion, and that was still growing 29.7%. GPV, or gross payment volume, sits above $50 billion, in this case $51.5 billion, that was growing 23.5% year over year last quarter. And so right now, this is what you're getting. A company worth around $20 billion, growing in a profitable way. Yes, you might not like this segment because if we go into a recession, it will definitely hurt a company like Toast. But so far, they see no indication of any slowdown. Right now, the stock sits here just under this key level right here at around $35, $36 or so. It did bottom. It seems to have bottomed at around $32, just like the majority of stocks that did get hit quite a lot over the past couple of weeks and months. Now, again, with Toast is getting you that exposure right in the restaurant industry. I'm going with Shift4. I've went with Shift4. That doesn't mean that Toast isn't a good business. I've just shown you the figures. It is a damn good business. I thought 2 years or so ago, I thought this would have been a business that would have gotten acquired by now. But it seems that they turned things around. They've become much, much better. They're growing very, very quickly actually, and becoming extremely profitable. So they've done extremely well, and I was definitely wrong when I covered that company, I think around 2 years or so ago. And the reason why I went with Shift4 and not Toast is because, again, Shift4 gives me that exposure to not just restaurants and not just the United States. Plus, it's also a smaller company. Moving on to a company that probably does not need any introduction, that's Amazon. Amazon's worth $2.5 trillion or so, trailing PE 33 times, forward one 31.4 times. Year to date, stock is now back up 6.7% because at one point it was down, right? We've seen the craziest thing. This stock has gone up after it reported their quarterly figures. A very, very good report, as you know. And then we've had the market pullback, and so the market decided to pull this stock back under where it was before they reported their quarterly figures. Yes, now it did make its way back up from the bottom around 7-8% or so. Now, Amazon, to me, as you know, is probably one of those companies where it will be on the list of companies to have for 2026. And of course, onwards, it's one of those companies that you just buy and hold. Amazon right now has operating margin of 4.1%, huge improvements, of course, over the last 3 years. And I do think that these improvements will continue over the next 10 years plus. Free cash flow margin 9.6%, gross profit margin 25.7%, and net profit margin currently at 4.7%. Looking at return on invested capital, that sits at 12.5%. It did peak for now at 14.4% a couple of quarters ago. But then again, as you know, Amazon is one of those companies where currently, yes, it's reinvesting quite a lot of money, investing quite a lot of money in the business. I do think that their return on invested capital is going to increase again in the future because, yes, they are one of the best capital allocators out there. Now, with Amazon, of course, the whole attention right now is on AWS, especially last quarter. AWS did increase more than 20%. I do expect that to continue for the next couple of quarters. If it doesn't, then yes, do expect the stock to get hit. But I am expecting them to continue to grow above 20% for at least the next year. Then, if we look at RPO, majority of it is for AWS. Last quarter, that did still increase 22% year over year to $200 billion. Then you've got all the other segments. And I know they might not be as sexy as AWS, but subscription is a business generating $48 billion over the last 4 months, growing 10.7%. Advertising business, growing 20.6%. That's a $64.6 billion business for them. So, yeah, are we surprised to see these types of things? I don't think so. I think right now, of course, there is a lot of attention going towards CapEx, huge increases in CapEx, although with Amazon, you also have CapEx because of the core business, the online store, logistics centers, and all of that. But if you look here at gross profit margin, that has been improving over the last couple of years. Yeah, free cash flow margin is taking a hit right now. You're seeing an increase of CapEx. We're probably going to see an increase of CapEx over the next 12 months as well. And then, yes, the big question is, what's the return on investment for these types of companies? They're spending so much money on, well, their cloud businesses, AI, and all of that. Again, AWS, Azure, Google Cloud as well. It seems like the market has forgotten that cloud businesses pre-AI have existed, and today everything's new. Now we know the margins on AWS are extremely high. They actually recovered this quarter. This is a very good business. This is a business that will continue to grow. And of course, I'm not just talking about the e-commerce side of things, because e-commerce as a whole, the trend, it's still up and to the right. That's why I've also put here C Limited. It's not like e-commerce is going away. I still think that the adoption for e-commerce is still going to increase quite a lot over the next couple of years. And yes, of course, I can talk again about Mercado Libre, because I do still think that Mercado Libre is also one of those no-brainers in the market. Now, looking at Amazon, the stock right now, yes, there was that gap from the earnings that got filled. We got all the way back here to 200-day moving average, which, yeah, was around $215. And then we went back above that key area right here. We're sitting at $234, close to $35, which was, yes, previous resistance. I do still think that this is a great company to buy and hold for the long term. And even if let's say there is a slowdown in economic growth, right, a recession, problem with spending that's going to hurt Amazon.com, well, I think that Amazon, just like Walmart, I think they're in an extremely good position to basically come out of difficult periods as bigger businesses, because they can be flexible with pricing. They can take a hit on that part of the business, because, yeah, especially for Amazon, subscription, advertising, AWS, third-party seller services are all growing much faster than the online stores, and or are higher margins as well. So in this case, I do still think that Amazon is also a good recession play, because, yeah, I think the stock will get hit, but that's an opportunity. And now, last but not least, of course, we have to talk about, I'm not going to end the year with this series by not including PayPal in this video, right? PayPal, of course. Although today, at the time of making this video, it is still green, it's still down 26.8% year to date. It's a $58.6 billion company at the moment, with a trailing PE of 12.6 times and a forward one of just 11.2 times. If we look at margins for PayPal, some people still think that this business is dying and not improving. Well, operating margin have improved. They're now at 18.2%. Free cash flow margin at 16.9%. Again, over the last 12 months, these are improving metrics. There were some one-time things here that happened. You can actually see this. If we put here quarterly, you will see it quite clearly. With free cash flow margin, you can see the 2 quarters. Well, PayPal has taken a hit that did affect it. Now, last quarter, free cash flow margin was 20.4%. Then gross profit margin, yes, that thing has declined over the past couple of years. That's now at 46.8%. And net profit margin is increasing a little bit, sits at 15%. Looking at buyback yield, you know me, I really hope they are accelerating the buyback, but it does not seem like that's happening anytime soon. But that still sits at 9.85%, and return on invested capital is improving a little bit. That sits at 20.9%. Now, of course, you've heard me talk about PayPal sometimes, right? Not that many times. But in my opinion, it still is. As long as we are in the 60s, even 70s, it is still one of the best risk rewards out there. Of course, you need patience. You need patience. You need the market to start reacting positively on all of the positive news that came out for PayPal. Of course, that's not all. We also need management to do its part, right? We've seen this reverse DCF that we did with Emir. Intrinsic value sits 110% higher, or more than that today, than when we did this exercise. And the assumptions here aren't that crazy. Now, going back to what I said, by the way, on Wednesday, we are going to have an analyst conference. Unfortunately, it's Jamie Miller, CFO. She does not sound very exciting. Now, the problem is that she doesn't sound exciting while talking about the exciting stuff of the business. So the last analyst conference we had was with Alex Chris, and that's when the stock went down a little bit more. It's the fact that, well, the business is turning around, is just taking more time than previously expected because, well, in this case, the issue is over 15 years of bespoke integrations across massive merchant base. This has created inconsistent patterns that are expensive for us to maintain and results in a terrible experience for customers. And the fix here is slow. That's not all. And this is something that I would love to see change this week. And that's, of course, the slowdown. Management observed a clear weakness in discretionary spend in the US and Europe. Again, for now, what we've seen is that Black Friday and, well, Thanksgiving week, I would say, spending has been better than expected. So hopefully we do get more color from PayPal, maybe Tuesday or definitely Wednesday. Once they do say that, okay, this has changed, right? Because previously they said the slowdown became more pronounced mid-September and has persisted into Q4. If they suddenly say, oh, we have seen a change in that, things are looking a bit better, yes, I do think that the market will react quite positive on that front. Then, yes, of course, I would love to hear more about Buy Now, Pay Later, Pay with Venmo, agentic commerce, and then, yes, the whole branded experience. Now, as you know, with PayPal, I do have some shares, but the majority of it sits in options. I still have the $100 March option, $100 June 26th, and then the rest is January 2027, which are bigger positions. So $90, January 27, 100, and 120. I'm still letting the $100 March 26 ride for the next couple of weeks. I think need it to reach around, well, PayPal to reach around mid $70 or so to be break even on those. If it does happen, then I do think that I will sell it and just buy more of the January 2027, probably $90. And so PayPal right now, yes, it seems to have bottomed right around here at around $58 or so. It's making its way back up slowly but surely. The time of recording, it is still up 0.57%. It needs to go back above $68 to really continue that momentum. Can it still happen in 2025? I do think so. Some positive data with regards to spending this week, then maybe a rate cut that could help it. New Fed chair could push this stock and the whole market up towards the end of this year. And so to end it, of course, as you know, I'm just talking here about 4 companies. I am bullish on quite a lot of other companies. I've made quite a lot of videos over the last couple of days talking about companies that are down, that are extremely undervalued, that are no-brainers and things like that. If you miss those will be in the top right corner. Of course, I'm still looking to buy more Nebius. I'm still looking to buy more of the maybe smaller players out there. And if we get a pullback like the ones we've seen with Meta, where suddenly Meta is at 600 or less, of course, I will take that opportunity to add to those great companies. Same can be said about Amazon, Netflix, some even say Nvidia, and Mercado Libre, and probably plenty of other names out there as well. So there are always opportunities in the markets. Just because I talk about 4 or 5 or 6 or 7 does not mean that those are the only ones. Far from it. So that's about it for me in this video. Do check out Fiscal.ai if you're watching this on Monday. Still have 30% off. Let me know what you think down in the comment section below, and we'll see each other in the next one. Bye-bye.